Hello, everybody. Thanks for joining us in early December. Chris Donraj is joining me. I'm Clayton Bland. We're going to walk you through the CLA Outlook for 2026. We're excited to share with you the content as we lay it out across the economy, fixed income, equities, alternatives, and then share with you some of our capital market assumptions. At a high level, as we've shared in Outlook webinars in the past, we really take a top-down view of the macroeconomic drivers, consumer finances, business conditions, labor market, Federal Reserve policy, and fiscal policy. And we combine that with the analysis that we bring, being a $15 billion RIA, one of the country's largest professional service firms, serving over 75,000 privately held businesses across the country. And we're going to tie that into what our view is going to be around equity markets, fixed income, and the private market. So, Chris, let's jump in on our outlook for 2026.
Yeah, let's go straight to the point. For 2026, Clayton, we think that growth, economic growth in particular, will accelerate. And we think that not only will growth accelerate, but we do think that inflation will stabilize and interest rates will move lower. All of this, which will be great for the economy.
Okay, as we go through this, Chris, the interesting thing is, if you look at the general sentiment in the market today, if you look at the fear gauge and index of what people are viewing, there's a lot of uncertainty. We've got a number of issues that we'll tackle as we go through this, but just at a high level, valuations at historic highs, uncertainty in geopolitical markets. Is Chairman Powell going to reduce rates here in December? Is the labor market actually going to continue to improve? Is inflation really subdued? All of these things are driving concerns, and that's a pretty aggressive forecast to say we believe growth will be above trend. And as the short end of the yield curve goes lower with Fed lowering rates and inflation stabilizing, let's get in and talk through why we have that opinion.
Yeah, Clayton, I was just thinking, I've done this for 25 years now. And when you think about the disconnect between sentiment, which is, if you look at the University of Michigan Consumer Sentiment Index, it's near all-time lows, over 30 to 40 years of history. And then you look at the market performance, all-time highs, economic growth accelerating. There's a huge disconnect here that I think is worth pointing out. And if you look on the screen here, what we are showing is sort of the economic report card, right? What does the current situation look like across the economy, Fed policy, consumer, business conditions, labor, and fiscal policy? And the one thing that to note is that if you look at the current state, we have mostly, greens and yellows, but we have under Fed policy quite a bit of red. Interest rates are high, and the Fed balance sheet has actually been quite tight with quantitative tightening. Fast forward to 2026 and beyond, the interest rate picture gets much, much better, Clayton, right? We have gone from interest rates of about 5%, and we are now at 3.25% to 4% and expecting to go even lower for the next 1 year. And so with interest rates coming down and with the Fed becoming a bit more dovish and adding more balance to the balance sheet, we think it's actually a good setup for the economy.
Yeah, that's that dry powder of the Fed. Don't fight the Fed. We believe it, and we'll see how that plays out. So let's take Federal Reserve policy as you just highlighted. You can see on the blue line, Chris, Fed funds rate. This goes back to the 2005 great financial crisis. Rates got hammered down. This ZIRP period of zero interest rate policy starting to get to a neutral policy on Fed funds rate, and then we get to COVID and slam back down with just driving a ton of monetary stimulus. But why do you see this forecast? You think that's really at this current range and 3.75% to 4%? Where do you think this ends up stabilizing over the next 12 months in 2026?
I think over the next 12 to 24 months, we're going to head back down to 3, maybe even slightly below. And the answer is why. And the reason is, well, when the Fed talks about its neutral rate, they're basically trying to keep interest rates just above the level of inflation. Inflation has come back down to that 3%, even a bit lower, if you look at core PCE. So we think that the interest rate picture goes down probably another, 75 to 100 basis points over the next year.
Okay, that's very positive. So the Fed's balance sheet is something that is, we've talked about it, but this is the amount of the other form of quantitative easing that has been done, where the Fed has stepped in over the last 20 years really looking at stimulating the economy by going out into the open market and buying treasuries, corporate debt, high yield, all different types of mortgage-backed securities. That spike throughout the 2000 teens coming out of the great financial crisis, and then again in COVID, another way to stabilize the global economy. This is an encouraging sign with quantitative tightening that the Fed's balance sheet has been coming down. In the forecast, do we see that as being stable, or is that just another lever that they have to use as we move through potentially GDP growth?
It's exactly that. I mean, the Federal Reserve, you can argue that under Chair Powell, it's been quite a conservative Federal Reserve. They've kept interest rates high. They've also been paring back the balance sheet through quantitative tightening. Fed Chair Powell's term ends next year, and there's early indications that the new Fed chair might be announced sooner than later, of which, if they were to be as dovish as some expect, not only would interest rates go down, but expect a resumption of quantitative easing, which means the balance sheet would actually go up, or at least, not go down as much as people have been thinking.
Yeah, Chris, if you go back, let's say 3 years ago, and the expectation at the time, if people really believed you were going to see the Federal Reserve continue to keep interest rates high, reduce their balance sheet through quantitative tightening, that in nearly every previous kind of economic cycle has been negative. But here we are in 2025, finishing off the year, not only with, let's call it price valuation and multiples high, but earnings continue to grow year over year. And it is, I think, one of these things that's made it a bit of a head scratcher to say, gosh, it doesn't feel like the right idea to be optimistic given that backdrop, but it seems to be working in this dry powder, as you alluded to, with the Fed being able to continue to lower rates to even just a neutral rate, not saying going back to zero, but that's a positive. So let's look at this. We talked about this earlier this year. Federal debt, the interest of that federal debt, it's been a big headline throughout all of 2025. What do you see here in this forecast?
It's remarkable. I remember in our earlier outlook around April of this year, we did a deep dive on both the debt and the interest cost of that debt. And one of the things that's really interesting is, at $37 trillion, we were hearing things about Doge and how aggressive it would get. Look, we are now at the end of 25, early 26, the debt is moving higher. We are at 37 trillion, and it's probably going to go to 40 trillion, 42 trillion, right? That forecast on the left is going to keep going higher. And what that means is that the interest costs on that debt, to pay down that debt, we are now going to be about 3.3% of GDP. So let's just put this in perspective, right? We are expecting to grow 2025 real GDP at 1.8%. Without that interest cost, we'd be growing at 5.1%. So there's actually a pretty big drag. And, the idea of outgrowing the GDP outgrowing the debt is something that is perhaps quite optimistic, and that's kind of behind a lot of the stimulus we're seeing behind it. But there's really no way around this. You have to outgrow the debt. You're not going to pay it down.
Yeah, GDP growth is going to be critical. So let's look at the implications for fixed income. And one of the first things to look at is the current yield curve, where we're at today. You can see the red line, which is as of October 31st. I think what's important to point out, if we go back to 2020, and this is the dotted blue line at the bottom, you can see this very flat yield curve where rates all the way from the short end of the curve all the way to 30-year treasuries, all sub 1%. Pretty remarkable period when you look back just as little as 5 years ago. What we're seeing in this forecast, in this kind of highlighted forecast range, when do you think we're going to effectively get down close to that 3%? Walk us through the next few Fed meetings.
Yeah. So look, you have a Fed meeting. We've already had 2 rate cuts this year in September and October. You have another one in December, 87% chance of a rate cut. And then you have 2 to 3 more rate cuts being priced in for the rest of 26. The one interesting thing that I think is a, you called it a head scratcher before, we have all this debt accumulating. But when you look at what does the Fed really control, they only control the near term of the yield curve, that 3 to 1 year period, because that's where the Fed fund rate is benchmarked against. So it makes sense that, the near end of the curve goes back into the range as it moves lower. What's really remarkable is despite all this debt piling up from the deficit, the long end of the yield curve is actually quite contained. It's not blowing out, which shows that despite the level of debt and interest expense, people still see the US Treasury market as the least risky of all government bonds around the world.
Yeah, and that when you say blowing out, we haven't seen 30-year treasuries come and be issued where they're going to auction and being, offered at north of 5%. And that is always a concern, that you get this blowout of yields and that higher interest rate expense. The other interesting thing, we didn't really build a slide around this, but if you look at the total amount of issued debt each year by the U.S. government, it continues to be at the low end of the maturity range. And so they continue to issue short-term debt that is ultimately, let's call it the operating capital for the government to continue to function and continue to run a budget deficit. So, real interest rates here versus nominal. One of the things that we were talking about earlier, Chris, is if you look at this gap on where real interest rates are versus nominal, this is still relatively attractive going back, these last 15 to 20 years.
Yeah. When you see the spread kind of blowing out, the spread between the blue line and the black line, it means that inflation is uncontrollable. The fact that you've basically had a constant spread and they basically track each other means that, there's a high expectation that when interest rates turn down and inflation turns down, that both nominal and real yields track each other.
Yeah, in the 80s and the 90s was a period, at least from a GDP and economic expansion period, not to say that this is the replication of that, but this feels very manageable. So if we look at credit spreads, which would be an indication of economic quality, this is another one of those areas where historically you look at that spread of high yield junk bonds relative to investment grade corporates, we're viewing this as very favorable.
When you look at what happens during a recession, nobody wants junky assets, right? Nobody wants to take any risk at all. They just sell their investment grade bonds or your high yield bonds, and they buy, treasuries, or they go to cash. You are not seeing this. There's a huge appetite for issuance in the high yield market and the investment grade market. From this perspective, there's no signs of recession.
Yeah, what is remarkable, if you look at the average spread, I'm just zooming in here, on investment grade to high yield, that historic of 146 basis points, high yield has traditionally been 500 basis points. So you traditionally earn 5% more by buying, high yield junk bonds versus investment grade corporates. Well, that spread today at 281 basis points, it is highlighting that the bond market in those corporate issuance is not seeing a lot of risk. So it's worth getting paid a lower level of spread. That's the market telling you it's not worried.
Well, the other thing that's interesting, we'll get to this later on, Clayton, but when we talk about private credit, why are people moving from the public credit markets to the private credit markets?
Right.
It's because the public credit markets give you no yield.
Okay, we want to touch one quick point on municipal bonds. When we look at the tax-free yield on municipal bonds, they have attracted a tremendous amount of flow into munis. If you look at that ratio of what munis are paying relative to treasuries, munis have been a very attractive asset class. And you can see that by the spread. As you continue to look at this ratio of municipal yields and treasury yields, it's historically at a low. So there is something to be said that we've had the money going in there. The market would say, hey, it's generated in looking at tax-free yields on munis as being really attractive. But they happen to be in that band where right now there's not much more room for muni yields to go much lower.
Put another way, Clayton, you got to be really careful where you're buying in the muni curve, right? Just simply blindly buying munis. Munis, you could argue in the near term, are quite expensive relative to treasuries. So the idea of actually being very tactical and buying individual muni bonds in certain states, maybe in the longer term durations, looks pretty attractive.
Yeah, which is another story around the credit quality and the confidence in these municipal bond issuers that they will continue to collect tax revenue, operate in a healthy environment, and meet those obligations is what has continued to attract people to buy those municipal bonds at these levels. Otherwise, they'd be demanding a higher yield if there was concern there.
Well, it's a great point. When you talk about treasury issuance versus muni issuance versus corporate issuance, the only thing that's going up is treasury issuance. Muni issuance and even corporate issuance has actually been quite contained.
Yep. Okay, so let's look at these asset class yields. Walk us through what we've got highlighted here.
So what you're seeing here is actually a pretty interesting chart. If you think about all the different types of income you can get in the market, whether it's the most risky part of the market in private credit, all the way down to U.S. Treasuries where you get dividend income, there's a whole different range of yields you can get. So let's kind of walk through this. On the left-hand side, the riskiest type of income or the highest income you get, and again, risk and high income should be pretty well correlated. There's no free lunch. So the riskiest level of income is in private credit, right? You're getting somewhere at the 10% plus range for ordinary income for private credit. And the question is, how do you get that income? A lot of that private credit, remember what private credit is, it's either asset-backed loans backed by real estate or some securitization, or it's corporate lending. And the only way you can make a loan at 6% and then give 10% to the investors, you use on leverage. So we have to be very careful about the level of leverage in the private credit space. If you look at sort of that middle area, you have investment grade bonds, you have preferreds, you have some areas of REITs and real estate, right? You're in that 4% range. The question is, what are you getting after inflation? If inflation's around 3%, you're only getting about 1.2, 1.5% of inflation adjusted yields. And so the last part is, well, you have those areas where you have lower income, but you hopefully have some growth. So let's take the far right. You have U.S. equities, which are generating 1.1% dividend yields. Looks interesting, but remember, it's not just the dividend yield you're getting with equities. You're actually getting appreciation beyond that. So what this chart tells you is you have to be very careful going forward in a lower interest rate environment where and how you get that yield.
Yeah, a challenging fixed income market for an investor. The other thing I just want to highlight, Chris, in private credit, I know we generally would categorize that as higher risk, but there are areas of private credit that are investment grade. And you continue to see there's a wide range, to your point, of really understanding what is it that is being purchased in that private credit space. So let's jump in and walk through the equity outlook. I think this is going to be a lot of insightful information and a lot of room for debate here when we look at, well, are the equity markets attractive? Are they overvalued? Should I own stocks? Should I buy stocks? Should I be selling stocks? And I think this is a point of reference we just really wanted to share with everybody is when you go back to the late 1990s and you look at these periods of drawdowns of what is typically considered bear markets, and in the S&P 500, here's the drops that have occurred. And for all of us in recent memory here in the 2020s, you can see 3 recent drawdowns of the S&P 500. Certainly with COVID, 34%, 2022, where we had a 25% decline there. And then again, which, 2022 that was just a couple of years ago. And then in the beginning of this year with the tariff tantrum or Liberation Day, the market selling off 20%. So why does this look encouraging to you, Chris?
Yeah, look, I mean, from the one part, you're talking about the clustering of bear markets. You have essentially, since 2009, 2020, almost 11 years of no bear markets, constant expansion, and then in rapid succession, you get 3 bear markets. Well, I would tell you there's really, 2 things that's really interesting to me. Number one is every time you get a big sell-off, so 2020, 2022, right, post-COVID, right, you have had the Fed come back in, and even the U.S. Treasury provide stimulus, which is why that when you get these bear markets, they're quickly reversed because you get some stimulus related to that. But what's interesting here is that you also have a pretty, interesting shift in the market, the stock market. We're going from, sectors like energy or even banking that have, shorter cycles to a market where you have majority AI related or artificial intelligence related plays. Yeah. And one thing that's encouraging about this is that if you look at the cycle for AI, that could be a 5 or 10-year cycle. So certainly you get these sell-offs, and this happens with the normal market volatility. Maybe it's macroeconomic tremors, maybe it's tariffs, maybe it's something else. But I think what's happening in recent history is people recognize that despite these sell-offs, the longer-term outlook and the trends for AI and spending on technology remains intact.
Yeah, the hard part, I think, Chris, for a lot of investors is the fear of losing money. And it's the fear of the market. Do I own it at the right level? What if the market goes down? And I'm going to zoom in on this. I think this is just one thing that we really wanted to highlight. This goes back to 1980. And you can see in the shaded columns, that was the full year return in the S&P 500. And the red dots are the intra-year declines from the beginning of each year. How far down did the market ultimately get to intra-year from that January 1st start date? And you can see volatility in the equity markets. It's been there for 45 years. And it goes back even further, but these are significant declines. It's just a great reminder that drawdowns and volatility is part of being an investor. And I think it's a great reminder that, okay, the ability to go through and say, well, how do you try to time this and pick those moments? Or do you continue to believe that that slope over time of the total return of being an investor, is that more attractive and worth riding through these intra-year declines?
Is the juice worth the squeeze? I mean, the average intra-year of any year since 1980 drawdown is 14%. So going into stocks, you have to be okay with the fact that at some time during the year, your portfolio might be down 14% or more. Right. On the other hand, you also have to be okay with the fact that the average return for US stocks over the past 100 years is 9%. So it's not about timing the market. It's very difficult to trade or time the market. You have to understand the risk and reward of being in stocks.
Yeah, absolutely. Similar with the bond market, not nearly as steep of declines. I think what's very compelling on this chart to highlight is you go back to the 70s with inflation and the rise of interest rates as we were combating inflation, and you can see these large drawdowns where back in the late 70s, early 80s of a 9% decline. And I think what's compelling here is that in 2022, a 17% intra-year decline in bonds. We've never seen that in our lifetime. Yeah. Ultimately, of seeing that type of decline and a full year return of minus 13%. So when you have that in recent memory and you look at, okay, well, what do we expect going forward? We don't see the opportunity for a massive decline or a significant intra-year decline in fixed income. Just that's not something that we're expecting to see.
Well, it's a great point. One thing to mention here is that, a lot of people, tend to gravitate towards bonds because of the limited sell-off, right? That in any year, you only lose about 3.5%. The problem is the average return on bonds is about 4 to 5%. And so you need to think about, certainly, I think if you have, an event where you need cash flow over the next 2 or 3 years, certainly it makes sense to have bonds to manage towards that. But if you think long term, inflation eats up a lot of that bond returns. And if you have a 5 or 10 year plus, horizon, you really need to be in a growth asset like equities.
Yeah, it comes back to, and this will be maybe a call for another time, but when you think about true financial planning and the time horizon and what the use is for that capital, that really influences the decision making on that allocation. But to your point, bonds traditionally have been a great ballast of that volatility, which they have historically been less volatile, and are a place to store cash in the need of some short-term spending. So this is another chart that we wanted to show that I think reinforces this perspective, Chris, of looking at time diversification and the volatility of returns. We just walked through the drawdowns intra-year of equities, and you can see in 1 year, the green shaded area is the stocks, blue is bonds, and then the gray is a representative of 60-40 portfolio. So this goes back to 1950, over what has been the widest dispersion of returns over a 12-month period for stocks, bonds, and a blended 60-40 portfolio. Clearly a wide variety of returns. As we move over time and you look at a 5-year rolling period, a 10-year rolling period, this again goes back nearly 75 years, you're looking at why do people say time invested in the market is way more important than timing the market? We believe that this will continue to be a trend worth holding to, that over a 10-year period, your downside volatility is reduced and stocks still offer attractive returns, and a 60-40 portfolio still offers fairly attractive returns when you look at these averages.
What's really remarkable here, stocks give you 11% average returns over a long time. Bonds give you 5.2%. you'd expect a 60-40 portfolio at 9.4% to be a little bit lower. But why is it 9.4%, almost closer to stocks? It's because every year or every quarter, you rebalance. If your stocks are up, you sell your stocks, you buy more bonds.
Yep.
And because stocks go up over time, you're basically monetizing your gains in stocks on a systematic basis. So being a long-term 60-40 investor is a remarkable thing. It's not that complicated.
A lot of debate on, is that going to work going forward? And happy to discuss in more detail if anybody wants to reach out. But let's just look at where are we from a price standpoint on what's expensive, what's less expensive. This has been obviously a big topic that everybody's talking about, where our current PE ratio on the S&P 500 sits. And if you take it, we'll go into a little detail on the Mag 7, Mag 10, and the rest of the S&P. But walk us through this, Chris.
Yeah, when you think about the stock market, what is your initial thought? Oh, it's expensive. And so when you think about what's expensive in the stock market, it's your growth stock. So think about your Mag 7, right? Even the S&P 500 has gotten pretty expensive because 40% almost are these Mag 7 stocks. And so there's been a lot of hand-wringing about, well, stocks are too expensive. If you drill down, Clayton, there's actually some areas of the market that we're tilting our portfolios towards in 2026 and beyond because they're actually kind of cheap, right? Exhibit 1, small caps. Small caps are actually quite cheap relative to their history. They're near 14 times PE versus the market around 23 times. International markets, we've actually had a fairly large international exposure, which has done quite well. It's still quite cheap versus the market. And so certainly there are parts of the market that are expensive, but this is how we build portfolios. We're taking valuations into consideration.
Yeah, and just to highlight one thing on this, on international developed stocks, you can see, I don't know if you can see it on the chart, Chris, but this little blue dot, that was the valuation as of the beginning of the year.
Yeah.
And throughout 2025, you've seen a major shift in rotation and the price movement in international stocks. Still not at the high end of the range where we'd say international is what we would call expensive, certainly less expensive, but not nearly as expensive as US large cap growth. But you can see that shift has started. We believe that trend will likely continue into 2026. Let's dig in a little bit deeper here when we look at this forward PE ratio. And then I think this is a great description of looking at, let's call it the S&P 490 versus the S&P 10.
So what's really interesting is, if you look on the left-hand side, right, that's the forward PE ratio. So that's next year's, it's today's price versus next year's earnings. One of the things that's really interesting here is that, yes, the PE ratio has gone up because the price in the near term has risen faster than the forecasted earnings of next year, right? That's why PE goes up. And in fact, it's above, one standard deviation, which is a statistical measure by saying this is pretty expensive over a long period of time. Now, one thing that's really interesting is if you look at the right-hand chart, the right-hand chart actually shows if you break down the S&P 500 between the top 10 stocks, think about these Mag 7 plus Eli Lilly and Berkshire Hathaway and others, right? The top 10 stocks have a very high PE. So they've gone up the most relative to their next year's earnings at 29 times PE. The remaining 490 companies are basically still in line with their long-term range for earnings growth and price to earnings forward or multiples. And so they're only at a 19 times PE. So one thing that we're trying to figure out in, tilting portfolios is, yes, we like being exposed to equities, but how do we get exposure to the remaining 490 companies and not kind of chase the top expensive Mag 10 companies?
Yeah, I think it's fair to highlight, when we say only 19.3, I think that's relative to those top 10. I think there's also the explanation, and there's a lot of debate on this, but when you look at an elevated PE ratio, you'd have to look at, well, what are the factors? Why is the market willing to pay this higher multiple of earnings, especially for forecasted future earnings? A big part of that right now, we believe, is in a monetary easing period with the Fed likely to continue to lower rates. It's one of the reasons why we believe the market is comfortable with this higher than historical average of this PE ratio of, let's call it 15.9 for those remaining companies. So a couple more charts here on equities, and then we're going to shift to another asset class. So this chart here looking at value versus growth. There is no doubt about it, Chris. This value trap that has existed in saying, well, you know what, we want to go after and own the cheap stocks, let's focus on value. But that's been a real challenging outcome, certainly over the last decade relative to growth. So what do you see here, and how would we advise clients between value and growth?
Yeah, look, you're exactly right. It is a value trap. It has been a value trap for 5 years. Let me kind of put it simply here, right? If you look at it, the growth companies, the reason why earnings growth is going down is simply law of large numbers, right? When you have the NVIDIAs, beating and guiding higher, the Microsofts beating and guiding higher, right? You're getting to a point where you can't grow as fast as you did the year before. Now, so that's a little bit misleading. These companies in the growth set are still growing extremely fast. On the other hand, I think one of the things you're seeing is that as interest rates move lower, your value companies, your deep cyclicals, your oil companies actually should do pretty well. There's an element of how do you value one versus the other? How do you balance one versus the other? I think our approach that we're using in 2026 and beyond is rather than taking a deep value bent, we can buy small caps and international companies, which are also cheaply valued, but also benefit from lower interest rates. So you get two for the price of one. I think that's a much better trade-off than just chasing pure deep value stocks.
You mentioned AI, efficiency gains, productivity. Where are we in this cycle of this AI transformation? There is a long-term bull case that one could subscribe to around the value stocks, those traditional companies that will benefit from the implementation of this development of AI, innovation, transformative software, efficiency gains, that even though those businesses aren't going to necessarily accelerate new customers or ramp up with new products that are going to drive significant growth, but they may be able to implement significant productivity gains that would drive earnings a growth rate faster than what has been historical. And that is something that we certainly subscribe to, waiting to see how that plays out. But we believe that that is a real potential opportunity for these value stocks.
What's a great point is that, we looked at that dividend yield of 1.1% for stocks. It's near its historical low. And the reason why is that most companies are investing back into CapEx or even hiring or other things. Right. There are companies in this value space, like oil companies, that have been dividend payers for the past 25 years, right? You're going to see them continue to return capital because they're also going to get even more efficient with AI. Yeah. So it's something to watch.
Okay, final slide on stocks. Let's just take us out on international here, Chris.
What's interesting, the most interesting chart is the far right. And what you're seeing here is this is earnings growth across the US, Japan, Europe, China, and India. And what you're seeing is that certainly we've had pretty good earnings growth, at least for everything but China in the past 5 years, right? And if you look forward, actually earnings growth across the world is accelerating. You look at international markets, one of the reasons why international markets has done so well this year is because of that forecasted earnings growth acceleration. Right. So this is behind this idea of this is actually a pretty good economic backdrop, which is leading to earnings growth acceleration. Very counterintuitive.
The middle chart here too, Chris, is something that this goes back to 2005. And the reality is for the last 15 years, there has been this discussion on relative to US stocks, international looks attractive. And you can see going back really to 2012, this continued decline that relative to US stocks have outperformed international. Well, whether this is calling the bottom or not, we have finally seen a bit of an uptick. And I'd say the view that we're taking is this the beginning of a trend where you're going to see this gap on, let's say, relative price to earnings discount? Will international catch up, and will you continue to see this upside? And that is an opportunity that we're focusing on. So let's switch to what we would classify as alternatives, Chris, and walk through what we're seeing here.
So one thing, as we talk about alternatives, I think one of the interesting thing is you're seeing an explosion of alternative products coming out. And the reason why that is you're seeing a lot of structures that give retail investors a lot more accessibility to these alternative markets, so-called interval funds that kind of act like mutual funds. And so one of the things we have to be very careful of is we've been investing in alternative markets for the better part of 20 years here at CLA. We've seen the ups and downs of these markets, And I think sort of to demystify, this slide shows you what are the returns across different types of alternative markets. So on the left-hand side are public markets, right? Your large cap equities has returned anywhere between 8.1 to 10% in a very tight range.
On a manager dispersion.
On a manager dispersion, exactly right. Bonds, still positive. What's remarkable to me is that in venture capital, for example, over the past 10 years, right, you still have managers that are negative for 10 years, right? Certainly you have some that have done really well, but this is, when you're buying venture capitals, you're buying individual funds. So there's no index fund of venture capital. You're at the mercy of doing due diligence. So fund manager selection, whether it's venture capital, hedge funds, even private equity, is very, very important. Who you pick will actually determine your outcome.
Yeah, it is quite fascinating around. You can even have some of the same firms with the different vintages of funds that they issue have significant dispersion. So it makes it challenging, and the risk reward there is certainly real, especially within private equity when you can have 20% plus returns, but you can still have funds within private equity over the last decade that have had low single digit. So it makes it challenging, needless to say. Real estate, Chris, certainly has historically always been that steady asset class, something that you can count on where you're going to get some form of rent income and long-term appreciation of the underlying asset. There's the tax benefits of it, but we're in a unique period in these last 5 years of what's occurred in real estate. Why do we think that this is an opportunity?
Yeah, look, the one thing you'll see is that real estate loves low interest rates. And one of the things you're seeing is that the past couple of years, as interest rates went up from 0 to 5% in very short order, real estate suffered dramatically, right? It also suffered from things like COVID and the return to office stalling, which hurt certain subsegments. But one of the things that's happening is that as interest rates go down, you're actually seeing a market clearing happening. You're seeing deals and transactions getting done, purchases and sales being made, and this is actually helping the performance of global real estate returns. And so while we like real estate, it's back to the basics here of making sure that we are looking for real estate that really generates income. So think about industrial real estate, senior housing, other types of things that are just very income oriented. And then the capital appreciation is important, but that comes secondary.
Yeah, real estate, this chart on the right on the volume of transactions, I think is really important. And I think everybody knows that if you own real estate for the long term, you're going to have a certain amount of CapEx that you're going to have to put back into the property to maintain it and improve it and update it. And in many cases, that is what occurs when a new buyer comes in. And this volume starting to return and the delay over the last 5 years, we believe there is an opportunity where you can find, let's call it B-class types of properties across office, apartments, even industrial, that you will see change hands that will be somewhat commensurate with the amount of loans that are coming due. Okay, the underlying debt for the existing owners, as they look to refinance, one of the concerns has been, well, with interest rates at an elevated position, refinancing that debt was going to be a problem and increase transactions. Well, with this backdrop of the Fed, that will be a significant driver, we believe, as supporting not only the value, but new transactions in which people will refurbish, update, and improve properties, which will drive rents and drive the value. Let's take a look at private credit. There's the number of, like I said earlier, a number of different types of debt instruments that fall into private credit. But how are we looking at it here, Chris, as an opportunity and as an asset class?
Yeah, look, I think private credit, it's one of those areas where you just have to be somewhat careful, right? There's some areas of private credit like commercial mortgages, right? You're going to have a huge wall of commercial mortgages come due, and you got to be careful about managers that are just all invested in just commercial real estate. If you look at the far right, there are other areas like office, for example, where we're seeing bigger delinquencies. And so I think there's really two takeaways for private credit. Number one, the manager type does matter, and being asset secured really does matter. But the one thing about private credit, and let's kind of be really precise here, when you're making loans to other companies and there's collateral, sometimes those loans go bad. So you need to have managers that are very, very adept at taking back those assets, addressing the market there and selling those assets to recover any kind of loan proceeds that they would have gotten otherwise. And so I think, there's a lot of folks in private credit. There's a lot of studies where private credit is the fastest growing area of the private or alternatives market, especially for retail. We want to be very careful and have the right sizing of this. The other thing to note, Clayton, is certainly CLA Wealth Advisories within an RIA, within a tax firm. Private credit generates, in many cases, ordinary income. It's not as tax efficient as regular real estate. And so you got to be very careful that a 5% or 10%, return is usually about half that when you think about an after-tax return. So this is something just to be considerate about.
Yeah, that's great. Okay, in private equity, certainly when we look at the opportunity set, and we've talked about this for years, the number of private companies relative to public companies, there continues to be a tremendous amount of opportunity in the private company space that are eligible for private equity firms to come in. You get the synergies of the integration of all the operations and fixed costs, operating expenses. This backdrop, when we look at kind of global private equity and the opportunities there, it should continue to be a significant increase of transactions, liquidity that's coming into the owners of those privately held businesses, and an opportunity for investors looking to participate in these private equity transactions.
I think it's a great idea. Look, there's two parts of this. One is private equity, I think, should be part of a larger portfolio, again, in the right shape and size. But the other point on the left-hand chart is you could also make the case, Clayton, that you have all these companies that are private, which will monetize themselves in the public markets. So there's an element of, putting all your eggs in one basket in the private market because you're trying to get access to the majority of companies that are private. But what if we get, as we're already starting to see, a huge IPO boom in the past 6 months? What if you start seeing capital markets open up? So there's an element of, we like private equity, but again, in the right size of the portfolio.
Yeah, which is effectively if you integrate 4, 5, 6 private companies in the same industry and you create a larger national conglomerate, at some point it is likely that that company will end up going public, listed on the exchange, and be a publicly traded company in which investors could own. So that is something we would expect to see here over the next 5 years. Last slide here on alternatives, Chris, on the secondaries market. What does this mean when we talk about private equity in the secondaries market?
Yeah, so when you think about private equity, these are funds with fixed lives, maybe 10 years, maybe 11 years, maybe 12 years. And what happens is at the end of their fixed life, you have a fund that may have some assets. Well, they promise investors that they'll give back the money after 10 or 11 years. They have to sell those assets in the secondary market to return that capital. And when you're selling illiquid assets in the secondary market, you have to sell them at a discount. So a lot of people buy these secondary assets thinking they're getting this great deal. And in many cases, it can be a 10, 20, or 30% discount to sort of the book price of those assets. The problem is that everybody's caught on. If you look at the right-hand chart, right, there has been so much interest in secondary pricing that it's actually come back up quite a bit. And so you just have to be very careful when you're buying secondary markets in private equity, that this good deal you might have gotten 5 years ago is less of a good deal now. Again, don't chase these markets, have the right allocation. They're important as part of a portfolio, but there's no silver bullet that will just be 100% of your portfolio that we would recommend any investor chasing.
Yeah, we highlight this secondaries market because it is an asset class that has grown in popularity to retail investors. And just to highlight, you can see that this gray shaded area in 2025 on the percentage of secondary market transactions. That's limited partner led. So if you're an LP invested in a fund and you want to get out before the fund closes, there is this area of secondaries where you can sell your interest in that fund. And then, of course, then the GP led, to Chris's point, on they're reaching their end of the negotiated term of the fund, having to exit certain positions. So maybe lastly, Chris, we'll just jump in and highlight the capital markets assumptions. And this is always a little bit of a difficult topic when we go through and say, well, what are the expected return estimates in the coming year relative to what 2025 estimates? And really to highlight, there's really kind of two key assets where we see a significant increase and the opportunity. As we mentioned earlier, you've got U.S. small cap stocks going from an expected return of in the mid single digits to low double digits. And then this return and an increase in private equity return estimates. Anything else that you think is worth highlighting here, Chris?
Yeah, look, I think of these four buckets, sitting in cash, Clayton, at the top in the blue, when interest rates go down, your return goes down, very simply. And again, one thing that's really interesting is if you think inflation is around that 2 to 3% mark, sitting in cash actually loses money. So then you go to the second bucket, which is bonds. Bonds have been pretty attractive as interest rates have started to come down, but they're going to get less attractive. So again, think about how much you actually need from a financial planning perspective in bonds. Certainly, you should use it for near-term cash flow planning, but long-term bonds are not going to outpace inflation or not be attractive without taking additional risk. So you really are left with equities in the orange space and then private markets. And I think, again, this is how do you invest for growth, but in a very diversified way. And one thing maybe to mention, Clayton, is that private markets are exactly that. They're private and they're illiquid, right? What is the opportunity cost of locking up your money for 10 or 11 years? And you're paying fees every single year versus a very liquid ETF. In our CLA strategies, we're at 6 basis points for the ETFs that we have from a product standpoint. So we have to be very careful to kind of weigh the cost of being in illiquid markets versus the flexibility of being in public markets. And again, all of these should be at least part of your discussion with your advisor, but there's no one magic bullet. This is about putting together the right portfolio that's diversified, that allows you to kind of weather the storm of any drawdowns, but helps you reach your goals.
Yeah, this is fantastic. Chris, thanks so much for the time. Appreciate everybody giving us the opportunity to share this 2026 outlook. We look forward to updating you next quarter, and we wish everybody a great finish to the year. Thank you very much.